Hi, and welcome. You're listening to the X22 Report. My name is Dave, and this is episode 858A, and today's date is January 4th, 2016, and the title of the episode is Economic Collapse Rears Its Ugly Head in the New Year. Now, before I get started with the report, I just have an announcement. Tomorrow, Tuesday, I'll be uploading an interview with Peter Schiff to start out the new year. If you are on the X22 Report email alert system, you will get an email. If you subscribe to the X22 Report Spotlight YouTube channel, YouTube should send you an email. If not, just come right over to the X22 Report Spotlight YouTube channel and you'll see the video there. Or you can come over to the x22report.com site, scroll down a little bit, look over to your right-hand side, you'll see the video there. Or you can check it out on newssentinel.com. That's NEWZSENTINEL.com. This is a news site where I'm streaming in alternative media around the world. I'm also streaming in videos from all different locations, so you can see all the information in one place. Let's get right into the economic collapse financial news. Let's head out to Greece, and we realize this January 1st, the bail-ins, they go live in Europe. And we understand that Greece, nothing has changed there whatsoever. Greece completely remains crippled by unprecedented capital controls, preventing full access of the local population to their savings. And right now, the people are starting to realize that there's no recovery coming. Their country is doomed, and these capital controls are not going away. And according to the latest Greece's central bank data, we're seeing that the deposit outflows are continuing. And people in Greece, they're not taking their funds, their money that they're earning, and placing it into the banks. They're actually taking them out. Now, the question is, why are they doing this? Well, they don't trust what is happening in their country. They realize that bail-ins are coming. They saw what happened in Cyprus, and most of the people are saying, you know something? We don't want to lose our funds. We don't want to lose our hard-earned money and get it replaced with stock from a failing bank. And they're completely unwilling to put their savings back into the banks. And this is troubling the central banks. They're trying to figure out a way to get people to bring back their currency, and it's just not working. And we can see right now the local population, they no longer believe a recovery is coming in their country. And the question is, how can they possibly believe anything is going to happen in their country except a collapse? Because nothing has changed there. The bailouts are continuing, putting the country further and further into debt. Now, out in the UK, they're telling the retailers that they're going to experience slower growth in 2016. And the reason they're saying this is not because of the economy, because consumers are looking beyond retail for goods and services to spend their money on. They're looking in other places where they're going to spend their money. They're not going to spend it on services like going out to eat. They're not going to spend it on retail. They're going to be spending it in other areas. Basically, what they're trying to say is the economy is falling apart. People are not going to be spending money in retail, so don't expect it. And this is going to get worse as time goes on. And the first day of the new year, as the stock market opens, we see that it's a complete and utter disaster. The market fell during the day like 450 points. Of course, we had the high-frequency traders, the plunge protection teams, step in and push that market right back up to what, negative 270 or so points. They did whatever they possibly can to make it better, to make it not as bad. But don't worry, they might be on the ball tomorrow. They might be ready for what is coming, and they might be getting more free money from the Fed to really push the market up. But what's very interesting is that we haven't seen something like this since January 4th of 1932, where the market completely collapsed and fell apart. And we are very close to that. And if we look throughout the other years, if we go back to 1932, it was down by negative 8.1%. 2016, we're down negative 2.4%. 1922 was negative 2.3%. And even if we go back, to 1983, it was negative 1.8%. And we can see at this point that this was a terrible, terrible opening for the markets. And we know the market is completely manipulated. We know this doesn't give us an indication of how the economy is doing. This is for the central bank. This is for those people who don't look anywhere else, and the only place they look is the stock market. If it's up, they feel that everything is fine. Well, that is the last indicator letting everyone know how the economy is doing, because the economy is already collapsing. It has collapsed. And what we've learned, and I talk about real estate quite a bit, and we know the government gives us this data, new home sales, construction spending, existing home sales, and we look through all the junk to find out what's really going on. Of course, the corporate media, the government is telling us that housing is in recovery. This is what you can expect from this new recovery. And I've been saying that housing prices have been coming down. It's completely impossible for new construction to be happening the way they're saying it's happening, because we looked at the rail traffic of lumber. It is completely down. The demand for lumber is completely down. And we come to find out the U.S. Census released its latest November construction spending data. It quietly released it because there's something wrong with it. And they came out with it for November, and it completely missed expectations, where they thought they were going to see construction spending rise to 0.6%, but it tumbled to negative 0.4%. Well, that's a miss. It's a lot worse than they thought. But we realize something else went on with the report. And in the fine print of the release, the government made a rare admission. And of course, I'm sure it's not all over the corporate media. They're not making a big deal of this. That the construction spending data for the past 10 years has been erroneous. So basically what happened is they had an error in their reporting. And in the last 10 years, they've been giving us information that doesn't reflect what's really going on in the economy. So they went back and they revised all the numbers for construction spending. And lo and behold, guess what? It's a lot worse than we thought. I mean, those months where they said construction spending was up by 4%, it was really 2.5%. The places where they said it was up 1%, it was 0%. And when we look at the graph and we look at the data, we see that we are in a decline. And in November, we finally hit the negative territory. So what does this tell us? This tells us that the real estate market, the construction spending, is not good. It tells us that this market is substantially lower than what they're reporting. That it's declining, it's collapsing. We're not in a growing economy. We're in an economy that's shrinking. So then they went back to new home sales, where they quietly revised all those. And it shows that we're once again in a decline. So we have existing home sales, new home sales, construction spending, all declining. Now everything makes sense of why prices are coming down and we don't see anyone purchasing. Because they're telling us that prices are rising and existing home sales are falling, but new construction is rising. Well, actually, it's all declining. And prices are coming down. Actually, we saw this back in 2007 going into 2008, where everything started to slide together. And this is what we're seeing right now. So once again, this economy is built on an illusion. And they're not going to go out there and say, oh, yes, everything is much worse than it really is. I mean, we look at manufacturing. The Chicago PMI, it's flashing red, flashing lights that we are collapsing. Well, today we get China's information about manufacturing PMI. I mean, that was terrible. And then we got Canada's PMI crashing to its lowest reading since records began. And their reading is at 47.5. And then the U.S. manufacturing PMI tumbled to 51.2, its lowest since 2012. U.S. factory orders have collapsed since this is the weakest since 2009. But ISM manufacturing crashed to 48.2, and it's deep in contraction, the weakest level since June of 2009. So what does this tell us? That a manufacturing recession is now inevitable. The only question is when and how it will spread to the service sector. This whole entire system is crumbling and falling apart around us. It's accelerating. And the US government has been feeding us fake numbers for 10 years in housing, and all the other economic indicators are showing us there are major problems, and this is going to spread to all different areas, and we'll start to see bubbles pop. The Baltic Dry Index has now fallen another 5 points to 473. The Atlanta Fed came out and said, okay, we realize what's going on here. We're going to have to recalculate GDP. We went from 3% down to 1.9%. to 1.3%. Well, now we're bringing it down to 0.7% for the fourth quarter. I wouldn't be surprised if it's a lot worse than that, but we know what the U.S. government central bankers are going to do. They're going to stuff the GDP any way they possibly can. They usually use inventory, they use Obamacare, whatever they possibly can do to get a positive number, that's what they'll try to do. And we're going to have to watch that to see how they go about doing this. Now, the Fed, as we know, raised the rates by 25 basis points. A lot of people saying there wasn't really an actual raise of the Fed fund rate, that they've used smoke and mirrors to make it look like they raised the rate. But they're already talking about reversing it. And Janet Yellen, if you remember, she came out and said before the Fed rate hike that if the outlook worsened, the Fed might have to reverse its decision and go to negative rates. Vice Chairman Stanley Fischer hinted once again at the potential of going to negative rates. So they're already set to bring the rates to zero, then to negative. They're just waiting for something to happen in the economy where they can make their case and say, okay, this is why we're doing it. And we know that the economic data that came out of the United States government, it's all manipulated information. And we know that the Fed allegedly raised the Fed fund rate during the weakest point of the economy if you go by what we were following. If you go by what the U.S. government is saying, yes, it looks like it's the strongest, but actually it is the weakest. And you can see already that this was a signal to everyone that this economy is coming crumbling down, just by the remarks that they mentioned before they raised the rate, because they're all set to reverse whatever they have done. We see that U.S. states, they're at risk. There are 5 states that are at risk of municipal bonds completely crashing. After reviewing over 300 comprehensive annual financial reports from different states, they pulled together an assessment of each state's total debt service relative to its tax collections. incorporating the need to pay down underfunded pension and retiree health care obligations. And they took 5 states where there are going to be significant challenges, almost like Puerto Rico. And those states are Illinois, Connecticut, Hawaii, New Jersey, and Kentucky. And I'm sure if they look further, they will see there's other states that there's problems. But we can see that this is going to spread, and it's going to spread very quickly. Marc Faber is out there, and he is warning Americans that the U.S. economic collapse most likely will happen this year in 2016. He says when he looks at the median price to earnings PE ratio for the U.S. stocks, he says they're relatively high, an indication that the market is inflated and the stock market bubble could burst at any time, sparking an economic collapse. And we can see that when we look at what's happening here in the United States and in Europe and in China. And remember, China is dependent on Europe and the United States purchasing. That's how everything is based, because they are a manufacturing powerhouse. If the United States, Canada, Australia, Europe, they're not purchasing goods, which we see this is not happening, manufacturing is going to decline. Baltic Dry Index is going to decline. This is what we've been seeing. We are heading to a point where things are starting to really accelerate. They're falling apart, and the collapse is going to be upon us. And this is why everyone needs to get ready and prepared. And we can see that this first day of the new year is a sign that this economic collapse is rearing its ugly head already. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.